Hey guys, this is Vyom Joshi with Superior North. Welcome back to my channel. Today we will be talking about SHEL, which is one of the largest energy and petrochemical companies in the world. SHEL was also featured in the Barron's newspaper recently. In this video, we will be talking about the company's business, then review the company's fundamentals by going over its key ratios, and finally find the intrinsic value of the company. So let's dive in and review SHEL. Hey guys, let's start off by looking at SHEL's annual report for the fiscal year that ended December 31st, 2021. On page 10 of this report, the company starts off by talking about its business. SHEL is a global group of energy and petrochemical companies with 82,000 employees and operations in more than 70 countries. SHEL uses advanced technologies and takes an innovative approach to help build a sustainable energy future. SHEL is a customer-focused organization serving more than 1 million commercial and industrial customers and around 32 million customers at 46,000 retail service stations daily. The company's strategy is to accelerate the transition of its business to net zero emissions, purposely and profitably in step with society. Next, on page 13 of this report, the company talks about its organization and the activities that the organization is involved in. The first one is Integrated Gas, Renewable and Energy Solutions. Integrated Gas manages liquefied natural gas (LNG) activities and the conversion of natural gas into gas to liquids (GTL) fuels and other products. It also includes natural gas exploration and extraction, the operation of upstream and midstream infrastructure necessary to deliver gas to market. After that, in the Renewable and Energy Solutions, SHEL is exploring emerging opportunities and investing in those where it believes sufficient commercial value is available. Renewable and Energy Solutions include SHEL's production and marketing of hydrogen, natural and environmental solutions, as well as integrated power activities. The second organization is Upstream. Upstream manages the exploration for and extraction of crude oil, natural gas, and natural gas liquids. It also markets and transports oil and natural gas and operates infrastructure necessary to deliver them to market. SHEL points out that while the upstream business is delivering the energy needs for today, it is also funding the energy for tomorrow and will play a fundamental role in supporting SHEL's ambitious transformation. The third organization is Downstream. Downstream manages different oil products and chemical activities as part of an integrated value chain that trades and refines crude oil and other feedstock into a range of products which are moved and marketed around the world for domestic, industrial, and transport use. Downstream products include gasoline, diesel, heating fuel, aviation fuel, marine fuel, biofuel, lubricants, bitumen, and sulphur. It also produces and sells petrochemicals for industrial use worldwide. The last organization is the Projects in Technology organization, which manages the delivery of its major projects and drives research and innovation to develop new technology solutions. It provides technical services and technology capability for its integrated gas, upstream, and downstream activities. It is responsible for providing functional leadership across SHEL in the areas of safety and environment, contracting and procurement, well activities, and greenhouse gas management. After that, SHEL talks about its segmental reporting. For the current reporting period, it has 5 operating segments, which are integrated gas, upstream, oil products, chemicals, and corporate. However, in the future periods, it will have 6 reporting segments, which are integrated gas, upstream, marketing, chemicals and products, renewable and energy solutions, and corporate. Now let's go to page 248 of this report to get a better understanding of its 5 business segments. The first one is the integrated gas segment, which manages LNG, GTL, and other products, as well as new energies portfolio. The second is the upstream segment, which explores for and extracts crude oil, natural gas, and natural gas liquids. The third is oil products, which comprises of refining and trading and marketing classes of business. The fourth is chemicals, which operates manufacturing plants and its own marketing network. The fifth and last is the corporate segment, which covers the non-operating activities supporting SHEL. Now let's look at the revenue breakdown across these 5 segments. For the fiscal year 2021, the total third-party revenue amounted to about $261.5 billion. Out of which the oil products segment brought in about $183 billion. Now, revenue is the top line number. However, by the time we get to the earnings, which is the bottom line number, SHEL's total earnings amounted to about $17.5 billion, out of which the oil products segment brought in about $2.7 billion. Finally, let's go to page 251 of this report to get a better understanding of where SHEL's revenue is coming from. For the fiscal year 2021, majority of the company's revenue came from Asia, Oceania, and Africa, followed by Europe and the United States. Majority of the intangible assets, property, plant, and equipment was located in Asia, Oceania, and Africa, followed by the United States and Europe. Now that we have a brief understanding of SHEL's business and its operating segments, let's review the company's fundamentals by focusing on its key ratios. Hey guys, I'm on Morningstar looking at SHEL under key ratios. We have the financials. The first item on the list is the revenue. The revenue is the top line of the income statement. This is the amount of money that the company brings in via sales. Back in 2012, the company's revenue was about $467 billion, and for the trailing 12 months, that number was about $290 billion. Over the past 10 years, we can see the cyclicality in Shell's revenue numbers. From a high of about $467 billion, it got to a low of about $234 billion in 2016. Then it got to another high in 2018 when it got to $388 billion. Then it dropped down to about $180 billion back in 2020 due to the pandemic. And now for the trailing 12 months, it got to another high of about $290 billion. This kind of cyclicality is common for an oil and gas company. Next is the operating income. The operating income is the amount of money that's left with the company once you subtract the cost of goods and operating expenses from the company's revenue. Back in 2012, the company's operating income was about $37.5 billion, and for the trailing 12 months, that number was about $29 billion. Over the past 10 years, there were 2 years when the company's operating income was negative. This is when the company's cost of goods and operating expenses exceeded its revenue. After that, looking at the net income is the bottom line of the income statement. This is the amount of money that's left with the company once we subtract the cost of goods, operating expenses, non-operating expenses, interest on its debt obligations, and taxes. Back in 2012, the company's net income was about $26.6 billion, and for the trailing 12 months, that number was about $21.6 billion. Over the past 10 years, there was only 1 year back in 2020 when the company's net income was negative, which is due to the pandemic. It's interesting to note that even though the company's operating income back in 2015 was negative, its net income turned out to be positive. This is likely because of some kind of restructuring and one-time sale that the company made, which made it report a positive net income number. Ideally, we want to see the company's net income, operating income, and revenue numbers to have a similar trend. That is, we want these numbers to be positive, staying steady, or increasing. Next is the dividends per share. Back in 2012, the company paid out about $3.42 per share as dividend, and for the trailing 12 months, the company paid out about $1.3 per share as dividend. Shell cut down its dividends back in 2020 when it was trying to conserve cash due to the slowdowns associated with the pandemic, and it has not resumed its dividend payouts to the pre-pandemic level. Next is the shares outstanding. Back in 2012, the company had 3,134 million shares outstanding, and for the trailing 12 months, it had 3,882 million shares outstanding. Over the past 10 years, the company shares outstanding number got to a high of about 4,174 million shares back in 2018, and ever since then, the company shares outstanding number has slowly been trending downwards. Ideally, we want the company shares outstanding number to be staying steady or decreasing. When a company shares outstanding numbers go down, that tells us that the company's management is buying back its shares, which actually helps increase the existing shareholders' ownership within the company. Next is the book value per share. The book value is what we get when we subtract the company's total liabilities from its total assets. So essentially, book value is the shareholders' equity. Back in 2013, the company's book value per share was about $56.24 per share, and for the trailing 12 months, that number was about $47.54 per share. Over the past 10 years, the company's book value per share has always been positive, which tells us that the company always had more assets than liabilities on its balance sheet. Finally, looking at the free cash flow. The free cash flow is what we get when we subtract the company's capital spending from its operating cash flow. Back in 2012, the company's free cash flow was $13,564 million, and for the trailing 12 months, that number was $32,273 million. Over the past 10 years, there was only 1 year back in 2016 when the company's free cash flow was negative due to the fact that the company's capital spending exceeded the company's operating cash flow. Ideally, we want to see the company's free cash flow numbers to be positive, staying steady, or increasing. I will be using the 2021 free cash flow of $26,104 million from my discounted free cash flow DCF analysis. Now let's look at the profitability of the company, focusing on the net margin. The net margin is the ratio of the company's bottom line to its top line, so it compares the company's net income to its revenue. Back in 2012, the company's net margin was 5.69%, and for the trailing 12 months, it was 7.43%. What this means is every $100 that the company made in sales over the past 12 months, by the time it paid for its cost of goods, operating expenses, non-operating expenses, interest on its debt obligations, and taxes, it had $7.43 left as pure profit. Next is the return on equity. The return on equity is the ratio of the company's income to its shareholders' equity. So it gives an idea of what kind of return can you expect on your equity in the company. Warren Buffett prefers to only invest in securities that have a return on equity of 8% or greater. For the trailing 12 months, the company's return on equity was 12.69%. Next is the return on invested capital. This number gives an idea of how good the management is at allocating the company's capital and getting a return on that investment. The company's return on invested capital for the past 12 months is 9.15%. Shell's weighted average cost of capital, also known as the company's hurdle rate, is about 7.5%. And since the company's return on invested capital is greater than its weighted average cost of capital, we can safely say that the management is creating value for its shareholders. Finally, looking at the interest coverage. The interest coverage is a ratio of the company's income to its interest obligations. So it gives us an idea of how many times can the company pay off its interest obligations using its income in that calendar year. Back in 2012, the company's interest coverage was 33.51 times, and for the trailing 12 months, it was about 8.22 times. Benjamin Graham, the father of value investing, preferred to only invest in securities that had an interest coverage of 5 times or higher. Now let's look at the financial health and liquidity ratios. The first item on the list is the current ratio. The current ratio compares the company's current assets to its current liabilities. Ideally, we want the company's current ratio to be greater than 1.0, as that tells us that the company has enough current assets to fulfill its current liabilities over the next 12 months. Back in 2012, the company's current ratio was at 1.18, and for the latest quarter, it's at 1.34. Over the past 10 years, the company's current ratio has always been greater than 1.0, which tells us that the company was never really in a liquidity bind. Next is the quick ratio. The quick ratio is similar to the current ratio except we disregard the inventory component. In other words, quick ratio is equal to current assets minus inventory divided by current liabilities. A quick ratio greater than 1.0 tells us that the company does not have to rely on selling its inventory in order to fulfill its current liabilities. Back in 2012, the company's quick ratio was at 0.74, and for the latest quarter, it's at 0.90. Over the past 10 years, the company's quick ratio has stayed fairly consistent. Next is the financial leverage. The financial leverage is a ratio of the company's total assets to its shareholders' equity. A financial leverage of 1.0 tells us that all of the company's assets are financed via its shareholders' equity. A financial leverage of 2.0 tells us that half of the company's assets are financed via liabilities and half of them are financed via shareholders' equity. Back in 2012, the company's financial leverage was at 1.91, and for the latest quarter, it's at 2.41. Over the past 10 years, the company's financial leverage has slowly been trending upwards. However, it has stayed fairly consistent since 2020. Finally, looking at the debt-to-equity ratio. This ratio compares the company's total debt to its shareholders' equity. Ideally, we want the company's debt-to-equity ratio to be less than 1.0. It's even better if it's less than 0.5. Back in 2012, the company's debt-to-equity was at 0.16, and for the latest quarter, it's at 0.45. The company's debt-to-equity ratio has a similar trend as the company's financial leverage. Now let's look at Shell's current valuation. The first item on the list is the price-to-earnings ratio. Shell's PE is at 9.0. The company's price-to-book is at 1.1. The company's price-to-sales is at 0.7. The company's price-to-cash flow is at 3.8. And finally, the company has a dividend yield of 3.6%. When we compare Shell's current valuation to its 5-year average, we can see that based on the price-to-earnings and price-to-cash flow metric, the company is currently undervalued. When we compare Shell to the S&P 500, and S&P 500 is the aggregate of the top 500 companies in the United States, and we can think about the S&P 500 as our opportunity cost. We can see that on all the valuation metrics, Shell is undervalued compared to the S&P 500. Now let's look at Shell's discounted free cash flow DCF analysis. Over here, I pasted the company's 2021 free cash flow number that I got from Morningstar, which was $26,104 million. I'm using an annual growth rate of free cash flow to be 4%. What this means is I expect the company's free cash flow to grow at 4% every year for the next 10 years. I'm using a discount rate of 10%. What this means is I want to get an annual return of 10% on this investment. In other words, I want to double my investment in about 7 years. I'm using a long-term growth rate to be 3.282%. What this means is after the 10-year mark into perpetuity, I expect Shell's long-term free cash flow to grow at 3.282% annually. This number is in line with the 30-year U.S. Treasury yield. The company has 3,882 million shares outstanding and has a long-term debt of $57,499 million. After taking all of these inputs into account, we get the company's intrinsic value to be about $91 per share. And when we compare this intrinsic value to the company's current stock price, which is about $49.93 per share, we can see that the company's current stock price is trading about 46% below the company's intrinsic value. The way we calculate this intrinsic value is we look at what the free cash flows would be every year for the next 10 years. We sum up all those free cash flows, which come out to about $194 billion. Then we look at what the free cash flows would be after the 10-year mark into perpetuity. We sum all those up to get the intrinsic value to be about $410 billion. From this number, we subtract the long-term debt and divide by the shares outstanding to get the intrinsic value per share to be about $91. If we disregard the perpetuity component, in other words, if you think that Shell is only going to grow for the next 10 years and then it'll cease to exist, then we get the intrinsic value without the perpetuity to be about $35 per share. And if we disregard the debt, in other words, if you think that Shell is going to grow into perpetuity, so there's no point for the company to worry about paying off its debt, Then we get the intrinsic value without the debt to be about $106 per share. Finally, let's try to figure out what kind of return can we expect to get on this investment if we were to invest in the security at the current stock price. For that, I will run a gold-seek analysis. My set cell is going to be the intrinsic value. My to value is going to be the current stock price. I'll run this analysis by changing the company's discount rate. What I get is if I were to invest in the security at the current stock price, I can expect to get an annual return of about 14% on this investment. Overall, Shell has good fundamentals. The company has a solid balance sheet and has a steady stream of free cash flows coming in every year. Shell's management is shareholder friendly. They recently increased the dividends by 4% to 50 cents per ADR, and they're also in the early stage of utilizing the $8.53 billion that's authorized for buybacks. Shell has the highest revenue among any European oil and gas company. Its renewable and alternative energy portfolio is tiny but growing. Shell started selling renewable power in Texas, and it recently bought India-based renewable power operator Spring Power. Shell's biggest advantage is its liquefied natural gas, LNG, whose demand is going up as Europe tries to divest from Russian natural gas. Hey guys, that is all I had for you this week. Hopefully you found this video on Shell interesting. If you like this content, please do like, share, comment, and subscribe. And if you have any suggestions on which stock I should review next, please leave it in the comment section below. I'll greatly appreciate it. Thank you.